Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon, we have Elde Guerrier. He is co-managing partner of Guerrier Development, and Nelson Chu, founder and CEO of Percent, to discuss how the macro backdrop has impacted real estate and private credit markets. Gentlemen, it's great to have you with us. Welcome to TradeTalks. And I want to get the 2023 environment, the macro backdrop, how it impacted real estate development. If you could fill us in, Elde.
The market is very interesting right now. Where the market is, you hear many talk on markets may bubble up or interest rates. Some, especially on the multifamily side, which is where my specialty is, where most of the guys don't think how we're going to do, where our numbers not matching when it's come to refinancing the debt that we have right now. So I have on my sector, I have many ways to help with that as well. But it's market is great, it's bullish, and we're in America. It's a bullish market, and it is thing that there's many things that we can talk about together that can overcome what 2024 look like in 2025.
Yeah, and we're going to talk about that in just a moment here. But Nelson, I want to get your perspective. It was an interesting year, right? We had the macro backdrop. We had interest rates. We had a little bit of a bank blip back in March, hence the spotlight on private credit markets this year.
Yeah, I think private credit was on the tip of everyone's tongue this year at the very least, especially with that bank blip that you mentioned. So private credit in general tends to be really popular in times of uncertainty, risk, volatility. You saw it in the global financial crisis. That's when it really took off, and you saw it again this year, right? So I think private credit really had its moment this year in the spotlight, and it's been consistent throughout. I think for the borrowers themselves, they've consistently needed to get more and more capital, especially in light of, for example, venture equity drying up. They need to find it from somewhere to continue to grow. On the lender side, I mean, it's a capital allocators market, right? You can dictate terms, you can take whatever you want, you can get higher yield than you could before. It was a really, really good year for private credit across the board, and you're seeing it actually impact other segments of the market as well, because it is actually more efficient, easier to raise money, less counterparties involved, less structure, all those things. It actually was kind of veering into like the leveraged loan market. People are using it for real estate. Like, it's been very popular as a result.
It's been very popular. I just want it to keep going.
Yeah.
We just got it.
I'm here to help you, so yeah.
We got to move it over in 2020, 2024, 2025. There's a lot of negative talk on the other side of it's coming down. It's not coming down. I'm here to prove everybody wrong again. I did it before, and I'm going to do it again. It's not coming down. I want the private sectors to come in and just let's push 2024, 2025.
Yeah, it was viewed as better than bank financing,
yes,
right? And much more easier than bank financing. So you saw a situation where I think the banks now are feeling so left out that they actually want to move into this in a more legal way that they can, because they normally traditionally can't do it. So they're leveraging asset management arms to do it. They're leveraging partnerships with other funds where they're not the primary. And those are all ways that they can kind of enter the private credit market to support things like real estate
finance.
Yes,
that is correct.
So Elde, did it change the way you're financing, how you structure deals for 2023?
Yes, it's definitely changed how I structure my deals. My capital stacks got changed very quick. And when you're dealing directly with banks, especially community banks, it's all relationship. Private market is just numbers. It's numbers. And yes, they're changing the interest rate, but in my firm, when I understand what the private market does, I had to start structuring my deal hybrid the two together. How from hybrid the two together, where the bank's starting to back up, to then I start pushing toward the private market, where my deal's been, I normally raise about 15-20%, to now I raise 30%, because I like to balance my sheet around 60-75%. So I raise my capital according where the private market, but the private market will feel comfortable for my deal to be able to move forward.
So I think, let's talk about the equity market for a moment here. It is digesting the news well that we're starting to normalize interest rates. It's anyone's guess how many basis points are going to cut for next year. I think the market's probably pricing in a little bit aggressive here. Will that change anything in terms of how private credit markets function, or are developers such as Elde appreciating the structure of private credit and don't want to go back to traditional lending?
I think you just look at the stock price for Affirm and Upstart to tell you sort of what it's going to feel like for private credit. I think Upstart's up like 80% a month or something like that. It's like crazy. But the reality is, in 2023, when there was just a lot of like talk from the Fed around, we're going to keep rates high, you got to see the economy come down and slow down, things like that, that puts a lot of pressure on these borrowers, right? Like they actually don't know when this whole misery is going to end, essentially. When you see the market like it is right now, and they know that there's a light at the end of the tunnel, even though now it's still expensive for sure, but there is a light, we can just survive until then. That just makes it that much more easy to stomach at this point, and they're just trying to like ride it out. So you are expecting, and we are expecting to see a lot of interest, a lot of refinancings happening next year, just to kind of make sure that the cost does come down. We saw it during COVID, where refinancings happened like very quickly because they want to make sure that they lock it in before it gets super expensive. And then you're seeing it now where they're going to definitely come back out to make sure they keep dropping their cost of capital.
Yeah, that's correct. That is definitely correct. Other point, as the private market's changing, as Fed's coming down, our assets, the private market, kind of like steady the federal Fed side, and then adjust with it. I would not operate on that sector without the private market, because in the beginning I was very scared of it, to be honest with you. To now it's good to keep things moving. And plus, when this comes to the refinancing, some of the, especially being in the South, for me, our capital, the bank don't balance as well as you guys in New York, where in the private market there is no limit. If your appetite can. If you can handle it and you show proof that it can happen, they will work with you.
Yeah.
And right now, and especially with the partnership as well with the traditional lending, the hybrid is starting to blend very well.
I also think too, people are looking for alternative forms of yields in their portfolio, right? So that's another reason why private credit is attractive. So you're looking at different types of structuring, different kinds of products, just to satisfy investor appetite.
For sure, and I think it's been interesting because our platform actually supports all ranges of investors, from retail to like family offices to investment advisors, all the way up to credit funds, right? And they just have their own yield target, which is tied to, in some ways, like the level of risk. So the retail investor generally wants like 10 to 12% above the risk-free rate. So now it's pricing what used to be like 10 to 12% is now closer to like 16, 17, which is very high.
Yeah.
Family offices and institutional investment advisors tend to want, I would say, like 8 to 10% above the risk-free rate. So you have to find products that fit that. And then credit funds are going to be more in like the, I would say, like 6 to 8% roughly, right? So there's a ton of interest and search for yields and in products that meet their criteria. So you are seeing a lot of different movement happening around sort of the structure itself to be able to ensure that they're investing in something that meets their mandate effectively, and they're able to actually dictate terms now more than ever because of the fact that it's a capital allocators market and borrowers are just taking what they can get at this point.
Yeah. From switching back to real estate perspective for a moment here, do you expect to develop more properties with rates normalizing, or in your mind has the market been strong enough to satisfy the demand? I mean, is there enough supply out there? Is that the bigger catalyst, lower interest rates, or the fact we need supply?
We need low interest rate and we need supply. If we go back a little bit, what happened, the reason market price, the housing market is where it is today, because just look at it. We got shut down for about, that's how much house we did not have in the market, when every small, from the little mom and pop developer to the builder that could not go out and build a house. Now that's what happened. It doesn't take that long. It doesn't take 2 years. It doesn't take 4 years. Within a year, if we are partnered very well together in private market, all aspect of the market, invest from every angle. If we go in, on our mind is we're gonna bring more houses into the market. Yes, the federal government rate, they don't move as fast as we can, especially in the private sector, which is I'm in the private sector. They cannot move as fast as we can. But as we are moving, it allows them to move better. On my side, it's completely different because I purchase according to how the market is going. I play, we're in the United States of America. We have so much data to be able to detect what the next 5 years is going to be by going back and steady. And plus with the technology that we have today, it's allowed me to purchase to overcome what that spread is on the top. So that's on my side. Now, every developer, when you talk about multifamily commercial sector, let's not talk about that. That's a different animal on its own. But on the multifamily side is how are you planning to move forward in 2024 and 2025? Are you willing to change? Are you willing to adapt? Are you willing to do the thing that you're not used to do to get more unit into the market? Strategize, and I can help with that.
Yeah, well, I mean, we certainly need the new development because you're not going to get people selling their homes if they have interest rates that are high 2s, 3s, even in the 4s, which I believe the stats like 70 to 75% of mortgages in America are there. I mean, unless you absolutely have to, why would you sell something where your mortgage is 3% and then you have to get one at 6.5%, 7%, even though the rates are historical norms, believe it or not. I just think it's the velocity of how fast rates went up that the affordability scale shifted overnight. I mean,
it's the cost of living increase versus the lack of wage increase, which is tying. So the prices for the houses themselves and the rates themselves are historically normal, but the cost of living increase and the wage increase have not kept up. And so it is still, from an affordability standpoint, from an attainability standpoint, it's still a challenge at the end of the day.
It's still a challenge, but we've been shocked. We've been riding a wave. I've looked at the market completely different. Again, I'm talking for myself, but we got into a place where we start get comfortable with the 2% interest rate. I was uncomfortable with the 2% interest rate because I know in that market, you're not supposed to be comfortable. Yes, enjoy the ride, but it's not gonna last for long. Once we start creeping down to the 6, 7, 8%, that market is not gonna last long. We need to balance. We're gonna balance back to a 4 to a 6. Basically, that's your gap. Okay, if the moment we get there, we have a really nice variable market, stable market that we can ride again for the next 10, 12 years.
Yeah, well, did we learn anything from 2008, 2009? Are you seeing households, whether it's in the corporate space, struggling with over leveraging again?
It's definitely happening. I mean, during Black Friday, buy now, pay later, skyrocketed in terms of usage, right? It was the highest they've ever seen it. Klarna's activity was up like 30%. So I think there's been some talk about consumer fatigue, and they're just like, you know what, I'm just going to YOLO this basically, because they still want to, even though everything's expensive, they still want to make sure they have enjoyment in their life, right? So that will unfortunately come to roost, and we are seeing that in the data already at this point. I think small business lending or small business activity in terms of repayments and things like that are tracking okay, not great, but okay. So a little bit days past due increase goes up, a little bit challenge on the repayment cycle, but consumer is just extremely rough. Default rates are definitely high, credit card usage rate is super, super high, and that's just a problem. I think credit card debt is like 1.3 trillion or something like that.
Yeah, but it's, what's so interesting though? Betting against the consumer has been a really bad bet.
It has been.
But I get it. Logically, it makes sense. We have student loans coming back online. We have over $1 trillion in debt. Things are much more expensive. I mean, we know there's been an inflation reset. Things are not going back to 2019. They might not increase year over year, but you're not going to see pre-COVID prices.
Correct.
And to your point earlier, wages haven't necessarily kept up with all of these increases, but it's still been hard to bet on the consumer. Look at consumer confidence data.
Markets are all-time highs. I mean, it's it's crazy. So yeah, it's hard to place a bet, but I think fundamentally, and just from a general macro standpoint, something is in the really strange, rough spot right now.
Yeah, well, and we were talking about this off camera, Elda, but when you think about affordability, and we're trying to think of another term to describe, that the housing market in particular, wages aren't always equal depending on where you live. What you make in New York might make things in Tennessee, where you're from, maybe very, very affordable.
Yes.
Relative to, we're spending what, 50-60% of our income on rents here. So I think, there's a lot of relativity that perhaps the data doesn't always pick out.
Yes, it don't balance on. It's not the same in every sector. It's on all states. So again, we don't have much time, but if you follow history, okay, it's simple. We can allow it to repeat itself, or we can choose to move forward. When I say moving forward, let's talk about, okay, we have a market, we got to get it going again, we got to get moving, we got to get things down. How do we do that? We don't write big checks into the people while they're staying at home. we need to put the money back into the small business owner, to the small chocolate shop that they just got an increase because of the material just got an increase. How do we fund those guys by putting more money into the market, where the private capital, where the banks can start releasing funds into a level where those guys can, we don't have to make the profit we made in 2022, but 2025, let's keep the doors open. Let's keep those 10 employees, 200 employees, 500 employees going to work so we can get the market back to where we need it. And another thing, when you're talking about interest rate, my first house was 7% interest rate.
Mm-hmm. Which is historically normal. That's historically normal.
Let's not let what the federal government, let's not that be shocking to us. So we say, oh, it's the interest rate. It's not just the interest rate. We need to get into a place where, hey, we don't need to buy a $1 million home right now, but we can get a $700,000 home. That's all it means. What we have been get used to, we need to adjust ourselves to know, hey, it was great, we missed it, but we get to touch it in the next few years. That's my philosophy.
But thanks to you, we can hopefully have more $700,000 homes, $500,000 homes that is actually, affordable, and the rate is less important.
Well, I mean, think about it. For the past 12 to 15 years, we are so accustomed to historically low interest rates, so much liquidity in the system, even though we might not want to have to think about a $700,000 home versus a $1 million home. It was not that far back, 12 months ago. I could have afforded the $1 million home, but because how rates have moved so fast, the interest on it totally changes the game when it comes to the monthly payment that I can make. I just feel like this dramatic shift that home buyers, even buying a car, same thing too with interest rates, that's a big shift. If you were able to afford, round numbers here, $1,000 a month, now it goes to $1,200 a month or $1,300 a month. Those are real numbers, and but we got so conditioned, and while it's our job, we're in the markets, we understand that. The average person who might not be exposed to the stock market, housing market, private credit markets, they're not thinking about that.
And it was the aggressiveness of the pace of change versus the comfortability we had over 12, 13 years that is causing, I think, the mental disconnect.
Right.
But I think over time, and with enough time, people will start to realize this is the new normal. Don't expect anything that dramatically different from what it is today. And now let's kind of level out the market.
Well said.
Yep, well said. All right, gentlemen, we will leave it on a positive note. Thank you so much for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.
Thanks so much.